Welcome guys to another video on labor economics. So suppose you are the owner of a firm that produces blackboard. What's your ultimate goal? Obviously your ultimate goal is to maximize your profit level. But always you may ask yourself, is there any way to bring some changes to improve your profit level? If you're working in a perfectly competitive output and also input market, so in this kind of market, you are the price taker and wage taker. So you do not have control over prices and wage. You have to take them from the labor market, from the output market. So if you want to maximize your profit level by selling your output and producing your output by using labor and capital, and you want to improve your profit level, you have to think about two things. The first, you can bring some changes for improving your profit level, those factors that you have control over. So as you don't have control over prices and over wages, so the only things that you have control over is your output quantity. So you may ask the questions whether to increase or decrease your output quantity in order to bring improvement in your profit level and increase your profit. And also the second thing that you should think about that is that how to make some marginal changes and examine each level of marginal changes in order to see either your profit level is increasing or decreasing. When you're thinking about marginal changes, you have to consider three situations, three conditions. The first one, if your marginal revenue is greater than the marginal cost of your output, you are able to increase your quantity of output level. Why? Because now you have the opportunity to produce and sell more and earn more income and revenue from the market. But if your marginal revenue is less than your marginal cost, it means now you're losing from producing additional level of output, so you have to decrease your quantity level. The third situation, which is the profit maximizing state, is that if your marginal revenue is equal to the marginal cost of your output, this is the output level that maximizes your profit. But the question is how you can bring changes on your output level. You can make changes in your output level by making changes in your input. As you are using labor and capital for producing that output, you can either increase, decrease, or keep it in the state that maximize your profit level by changing in the inputs. So how you can bring changes in the inputs, you have to think about three situations here as well. If the marginal revenue product of an input is higher than the marginal expense of an input, you should hire or employ more input. Because now your input create more revenues than the marginal expense that additional level of input create for you. And also, if your marginal revenue product of an input is less than the marginal expense that may create for you, so at that time you should employ less inputs. Because now if you employ more input, the expense or the cost will be more than the revenue that additional level of input may create for you. But if the marginal revenue of product that an additional unit of input may create for you is exactly equal to the marginal expense of that input, you should not bring any changes. And that's completely the situation that maximizes your profit level. That maximizes your profit level. So let's provide a brief definition for the marginal revenue product and marginal expense. What are they? Marginal revenue product is extra revenue generated when an additional unit of input employed. For example, if this input is labor, how we can define marginal revenue product of labor? Marginal revenue product of labor is extra revenue generated when an additional unit of labor employed. And marginal revenue capital, marginal revenue product of capital is an extra revenue generated when an additional unit of capital employed. When an additional unit of capital employed. What is marginal expense? Marginal expense is the additional expense that employing one additional input, either capital or labor, may create for the company. So now, the next question is that how we can derive marginal revenue product of an input. So the marginal revenue product of an input, for example, marginal revenue product of labor or marginal revenue product of capital, we can find this from this formula. Marginal revenue product of labor is equal to marginal product of labor multiplied by marginal revenue. What is marginal revenue? Marginal revenue is the change in total revenue by selling or producing one additional unit of output. One additional unit of output. For example, as I said in the beginning, if you're producing a whiteboard or blackboard, marginal revenue for you is that if you sell one additional unit of blackboard, how much revenue that additional unit of blackboard may create for you. That's called marginal revenue. And in the perfectly competitive market, marginal revenue product is equal to the price. Then instead of MPL multiplied by MR, we can write down MPL multiplied by P, because in the perfectly competitive market, marginal revenue is equal to price. So instead of marginal revenue, we can write price. And marginal revenue product of capital is equal to marginal product of capital multiplied by marginal revenue. Again, instead of marginal revenue, we can write down price. But let me define you what is marginal product of input, either capital or labor. We can define by this: a marginal product of input is change in output when an additional unit of an input is employed, when other inputs are being fixed. So, and marginal product of labor is the change in output when an additional unit of labor is employed, when the capital is being fixed. That means when you use one additional unit of labor, how much output will increase when you keep the capital fixed. And marginal revenue product, marginal product of capital is an additional unit of output when you increase one additional unit of capital while your labor is fixed. This is the definition for marginal product of labor and marginal product of capital. So here, in a mathematical way, marginal product of capital is the change in marginal product of labor is the change in output over to the change in labor, while holding capital fixed. And marginal product of capital is equal to the change in output over to the change in capital while holding labor fixed. So it means when you are deriving marginal product of an input, we keep other input fixed. We just bring changes in one input to find out the effect of that changes in the output level, while other factor of production is fixed. So why we are doing this In the next video, I will talk about how we can use this marginal product and marginal revenue product in order to drive the demand for labor. And also, when we talk about marginal expense of an input, marginal expense of labor is equal to wage, and marginal expense of capital is equal to C, or the cost of capital. Why is this? Because when a firm operates in a perfectly competitive input market, so the wage level that the firm will pay for the all employees, for the all additional employees, will be equal. If you hire one employee, you will pay the same wage. If you hire the 10th employee, you will pay the same wage. If you rent 1 unit of capital, you will pay the same cost of capital for the 1 unit. When you employ the 10th unit of capital, you will pay the same cost of capital for the 10th unit of your capital, because the cost of capital and the wage level is fixed, and you have taken them from the labor market, and you cannot bring any change for them. So that's why marginal expense of labor is equal to wage rate, and marginal expense of capital is equal to the cost of capital. So the ultimate or the optimal level of input combination or input is the state that marginal revenue product is equal to marginal expense. So here, when we can say when the marginal revenue product of labor is equal to the marginal expense of labor, this is the optimal condition of hiring or employing labor in the company. And we will talk about how to drive labor demand from the marginal revenue product and also from the marginal product of labor in the next video. I hope at least now you know the concepts of marginal revenue product and marginal product of an input. Hope to see you in the next video. See you next time.